Welcome guys, this is going to be another video in the Wyckoff series. It's been I think the most requested that I have in my series and the most viewed. And one of our subscriber asked me to do more videos on this and more theory. And in this one I want to give an example that happened on the pound versus the Australian dollar that I'm in a trade right now. But I want to tell you first the thought process, and second, I want to put an emphasis on the management of risk, because I think that's the most important part about trading in general. And it's especially true when you trade patterns that are by nature counter trend. So let's get into it. If you want to follow me on TradingView, I go under FX Brawler, if ever that's any of interest to you. And I want to preface this by saying that what I put up on TradingView is more ideas than trades per se. I don't think you should ever follow exactly the trades of people that post things on TradingView, but more use them to improve your trading and see what they're looking at, because this idea was basically me watching the price going in a downslope like crazy, and then I saw that price was trying to get on top of it, but there wasn't any confirmation yet. The bar wasn't closed or anything. So, but this kind of pattern, usually when volatility really decreases and it starts to accumulate, like right now it was doing like the start of an accumulation pattern, but then it went and popped on the downside. But at that moment specifically, I went to bigger time frames, and I saw this on the weekly, and this big trend line was acting like a really strong support. And what I wrote was, be aware that there's a support below that might act like a magnet, so it's important to wait for proper confirmations or have really wide stops to account for a spike down before the move. And that's exactly what happened. So I think that whenever you put up a trade, or you have an idea of a trade, I should say, you should always first do a top-down analysis. Like, you go on the weekly and work your way down. Look at the daily, the 4-hour, and usually my trades are not based on a lower time frame than that. If I go on a lower time frame, it's because I already know that I want to start getting a position, and I'm looking for an entry point. But as far as the idea itself of the trade, I always start with the bigger time frames. So let's see what happened here. So the price went down. So at this point, I have to redraw my lines, and that's normal. When you do technical analysis, patterns form and deform, and you have to really adjust to what is going on. Because you see here, the candle that looked like it was gonna pop up actually did wicks and reversed on the downside. So I never took a position at that point, but I want to show you where I got in and why I got in. And I used the principles of accumulation in order to get in. I wouldn't, like, I know that a lot of my videos call them Wyckoff, but I think a little bit too much credit is due given to him, because really accumulation takes many shapes, and I think it's more of an idea of several waves that are made on the downside, and then the price continuously gets rejected by a support and then starts popping up, and I guess you could call that a Wyckoff if you want, but it's really the concept of accumulation that's more important to understand here, because it takes many shapes, and most of the time it doesn't take the Wyckoff shape like it's on the diagram and like the theory shows. But I've learned to play around that and play more with triangles, and that's what I'm going to explain to you in this video. All right, so let's start from the weekly. So we saw that price went low here, and this to me looks weak in the first place, okay? And the reason for this is that when you look at this support, price was rejected, and you see all these wicks close to the line. So really, if you took the bodies, it would look something like this, the support, the base of the bodies. So when a full candle is able to close below these wicks, then that's a sign of weakness. So I don't put too much stock into this trade being successful. I actually think it's going to fail, but there's a chance that it might bounce and it might do some type of reaction, and I might be able to lock in some profits. And I want to show you, and right now I have zero risk on the trade anymore, and the reason is that I did a top-down analysis, and I chose my entry carefully. So this is the weekly. Let's go on the daily, see what we see. So we have our big downtrend, and here I was starting to see wicks. Okay, so what I like about this is that in the same principle like we see with the Wyckoff technique, we know that the third wave, the last one, usually is a bear trap in the case of the accumulation pattern. So it goes beyond the support, and then smart money gets in at that point and really gets the best price possible. And when I saw these wicks here on these candles, I was like, okay, this is the actual support right now. So let me go on to a smaller time frame and see if I can find an entry. And this is the 4-hour chart. Nothing too visible here, but these candles, these three, to me at that point I was like, okay, maybe this is the a Wyckoff type of accumulation, and I drew a triangle to start with. This was what it looked like in the beginning, but then that evolved as I analyzed smaller time frames. So let me show you. I then went on the 30-minute time frame, and you see this is the support that got penetrated on the downside, and you see the price is really messing around in that zone, and it created a range. So these were the 3 points with these candles that we saw these big wicks from. So at that point I was like, okay, so that might be the support I'm looking for. And when I draw lines like these, I usually, when there's big wicks like this, I like to put my line at the 50%, like half of the wick is my starting point. So it creates kind of a descending line, and I try to catch the support like that. And to me, this is a good enough. Like, it's not, I would have liked it to be a bit further down to really trap people up, but there we saw a clear reaction, like really aggressively, and it went back to test the previous support, which is now resistance. And remember, I drew that line here. That was the first idea. And that's the first point where I got in. It was when the price actually closed on top of that line. That was my first entry point. But in general, I find that the very first wave, the first reaction of the entire pattern of accumulation, this one, is not always the best spot to pick an entry. What I usually like to do is I try to pick the second top and then the third top before the snap here. So by drawing this, usually I can find a better support. So if we take the 50% rule that I talked about the wicks, I would lower this support to around here. So that would be a place where I could find support in the future. That may or may not work, it depends. You have to play with your lines a bit, but it gives you a general idea of where to place your line. Here it was actually the top of the candle with the bodies of the rest that gave the exact low, but that's not how I drew it in the first place. So I want to keep it as real as possible. So the first point of entry was around there, and then it went there to snap, and it came back. And remember, in a previous video I was talking about the pump and dump. Well, this is the nature of it here. So you have the big pump, and then it dumped right away, and it comes to test the triangle on that line. So let's draw it properly here. Now we have the benefit of hindsight, but that's not always the case. So now we have our triangle that's traced, and this is the structure that I'm looking at right now. And if this structure gets broken, then I know I'm wrong, okay, on the trade. And let me just see my average entry. So 1.81439, 1.81439. So this is my average price right here. So that's where I'm long from on average. So I got in a bit here, and then I got in a bit later. When it came to bounce and it was starting to react, I bought some more. So I have two positions. I don't give much stock on it being able to keep on going up. But if ever it does, I'm positioned. So this is my area of support, and this is my area of resistance. This is what we're looking at right now. And if you take the zone from the first wave with the high of the pump and dump, gives you another support line. So right now I'm long in this area around here, and it broke up. So I'm in profits. I'm right now I'm 56 pips in profits, and I'm expecting price to come and test this line at this point. And I'm not gonna add anymore because I don't really like the trade, but I thought it was worth it to give it a shot anyways, because usually when I stand on the sideline and I identify a Wyckoff pattern or an accumulation pattern, however you want to call it, and I don't take it, I'm mad at myself. And it's even worse psychologically than a loss when you think you know what's going to happen and you don't act on it. So I acted on it. I got a long position anyways, just in case. But what I did at this point is I moved my stop loss to my entry point. So I have zero risk at this point, nada. So it can do whatever it wants. It can reverse, come back to my entry. In that case, I won't touch it anymore. Or if it goes in my direction, then I have exposition to the volatility of this pair. So that's an advantage. So right now it looks like it's kind of holding a bit, but I wouldn't be surprised if it came back down here and tested again. If it breaks on the downside, I'll be locked out. Not locked out, but I'll be stopped out with zero. I put my my stop loss at the entry price plus commissions from my broker. So I will have lost absolutely nothing. So from this point, what we would like to see is price coming back up to this area and then create some kind of accumulation pattern and then move on top. And if I see accumulation here and then it pops on top of this resistance zone, I will add to my position and I will move my stop loss from the previous positions a bit higher here at this low if ever it makes one before it breaks, because now I can lock in profits. Right now I've locked out risk from the equation, which is the money management part that I wanted to touch on. But if it goes in my direction, then I will lock in profits, and that's important as well, because you don't want to limit your profits, but you really want to play defensive. When you use these patterns that are counter trend by nature, you want to be very defensive about how you manage your money. Because my goal every single day I scan over 100 instruments. It can be commodities, I look at stocks, I look at Forex, I look at all indices, ETFs, all kinds of stuff. And I try to find an opportunity. I want to find exposure, because if you're not invested in anything, you have absolutely zero chance of growing your capital. But the way to achieve long-term growth in your portfolio, in your assets, is to take some risk, but then manage that risk and limit it as soon as you can, but keep the exposition. I could get out right now and I would have made a nice profit. I mean, that would be I could live off of that, of what I've made this week, you know. But my goal is to make more than that. I want to grow even bigger than that. So I'm managing my risk and I'm waiting to see what happens. So that's about what I wanted to talk about this trade. I don't know what's going to happen. I might get locked out, but or taken out of this trade, but I do have exposition and I have zero risk. So I hope that was helpful to you. Please give it a like to the video if you did, and I'll see you in the next one. I have another Wyckoff video lined up for you guys. So see you soon.